Venture capital isn't just about cutting a check, it's about fueling growth, guiding founders, and helping startups navigate the unpredictable journey from early stage hustle to market success. But not all investors take the same approach. Some dive in headfirst, actively shaping the company's direction, while others take a step back, offering support only when it's needed. For investors, understanding different engagement styles is essential to maximizing impact. The right level of involvement can accelerate growth by providing strategic insights, industry connections, and operational guidance. However, too much oversight can slow decision-making and create friction, while too little engagement may leave founders without the support they need at critical moments. Striking the right balance ensures that investors add value without becoming an obstacle. So, what does active versus passive involvement really look like in practice? Active investors don't just put in money, they put in time, energy, and resources to help the business succeed. They see themselves as partners, working alongside founders to shape strategy, refine operations, and build a strong foundation for growth. This often starts with a board seat, where they play a direct role in long-term decision-making. From hiring executives to approving major strategic moves like fundraising rounds or acquisitions, active investors help guide governance and ensure the company stays on track. But their involvement doesn't stop in the boardroom. Some work closely with founders to optimize financial models, streamline operations, and develop scalable growth strategies, especially in the early stages when every decision can make or break the business. One of the most valuable things an active investor brings to the table is their network. They help startups recruit top-tier talent, connecting them with experienced CFOs, CMOs, and CTOs who can take the company to the next level. They also open doors to critical business development opportunities, using their industry connections to secure key partnerships, distribution deals, and enterprise clients. And when the road gets rough, as it inevitably does in the startup world, active investors step in. Whether it's navigating a crisis, pivoting the business model, or managing a downturn, engaged investors work alongside founders to solve problems and keep the company moving forward. This hands-on approach is especially common among lead investors and boutique VC firms that focus on specific industries. For early-stage investors, striking the right balance between engagement and autonomy is key. Providing strategic guidance, leveraging networks, and helping founders navigate challenges can significantly impact a startup's trajectory. However, over-involvement, whether through excessive oversight or rigid strategic direction, can hinder agility and decision-making. The best investors empower founders while offering the right level of support to maximize long-term success for both the company and its stakeholders. Not every investor wants or needs to be involved in the day-to-day operations of a startup. Many, especially those who invest in later-stage companies or have large, diversified portfolios, take a more passive approach. They provide capital and occasional support but trust the founders to lead. A passive investor might attend board meetings but stay out of operational decisions, offer introductions only when asked, and focus primarily on tracking financial performance rather than actively steering strategy. They're less likely to intervene unless the company is facing a major inflection point, such as an acquisition opportunity, leadership transition, or a significant market shift. This approach is more common in later-stage funding rounds, Series B, C, and beyond, where the company already has an established business model and doesn't require as much hands-on guidance. It's also typical of institutional investors, like pension funds or sovereign wealth funds, which invest at scale but don't get directly involved in operations. For some investors, a hands-off approach aligns well with their broader investment strategy, allowing them to back strong founders without getting involved in day-to-day operations. This model works best when investing in later-stage companies or in experienced entrepreneurs who already have the networks and strategic expertise to drive growth. Providing capital without direct oversight can also enable founders to execute their vision without unnecessary friction. However, for early-stage investments, a purely passive approach may limit the investor's ability to provide strategic value and support founders during critical inflection points, potentially reducing long-term returns. For venture capitalists, deciding between an active or passive role isn't just a matter of preference. It's a strategic choice that should be aligned with the fund's investment thesis, the stage of the company, and the specific needs of the portfolio. Early stage investments often benefit from a more hands-on approach. In these deals, actively engaging with founders can help shape the company's early trajectory, de-risk the investment, and lay the groundwork for future growth. But this level of involvement requires time, capacity, and the operational expertise to provide meaningful value. In contrast, for later stage deals or highly experienced founding teams, a more passive model may be appropriate. These investments may not require day-to-day support, but still benefit from capital, governance oversight, and selective strategic input at key moments. What's most important is that VCs set clear expectations at the outset. Before leading a round or joining a board, investors should define their intended level of involvement. Will they take a board seat or observer role? How frequently will they engage with management? Do they have the capacity to support hiring, partnerships, or strategic pivots? This clarity allows both parties to align on responsibilities and avoid mismatched expectations. It also helps VCs manage their portfolio efficiently, prioritizing where to deploy time and resources for maximum impact. Ultimately, great venture investors aren't just capital providers. They are disciplined partners who know when to lean in, when to step back, and how to consistently add value across a range of engagement models. Understanding and executing the right investor role is not just a relationship choice. It's a key part of driving portfolio performance and long-term fund success.